Please, speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
It is Saturday. Once again, we're back. Another weekly market recap. And boy, oh boy, things keep on being volatile with all that's going on in the Middle East, with what we are looking at in the private credit market, and all the things you can name. I mean, at this point, it looks like the perfect storm for volatility. So, without further ado, let's keep on the intro completely. And let's just try to be quick and move on to the economic calendar first, and then, of course, the charts, right? Let's jump into it. As for the economic calendar, we started out with CPI, which came in month over month. It was like 0.2%, so 20 basis points, which gave you a read of 2.4 for the year over year. So, you know, in line with expectations, pretty much, and still relatively low compared to the current trend. Now, remember, these are the data for February, so nothing of what's going on in the Middle East right now is being picked up in here. So if you see a little bit of an uptick coming into the March or April read, you know, it's absolutely normal because, you know, those price increases will be reflected down the road throughout the entire economic chain because energy is reflected everywhere, right? So for now, this is it. The core inflation rate came in 2.5, so, you know, didn't see a huge variation compared to the previous months. So that leaves you with what? Well, you know, inflation, which is not really going up for now, although there are a lot of risks there and a few certainties with the price of oil spiking to 120 at the beginning of the week and then pulling back, but still, you know, closing the week relatively high. I think the problem for now would be what the Fed's going to make with it, right? Are they kind of tied up? Like, I mean, they can't really cut rates now because of the inflationary risk, but on the other hand, they cannot really hike because of the labor market, right? We've seen NFP coming in at minus 92K. So I think at the end of the day, they're not going to touch anything. They're just going to go in wait and see mode and see what's going on. But I do think the balance of risk is shifting. So if they have to take one side, I would guess that they're going to try to protect, so to speak, the labor market. And I think even if oil price keeps on being relatively high, they might cut if the labor market goes and, you know, the financial markets just go out of whack, right? That's just my feeling, all right? Then what we got, GDP growth rate, which came in, I mean, those are the revisions. You know, we got the headline a few weeks back, which came in at 1.4 for Q4 2025, and now the estimate was revised lower to 0.7, whether you believe it or not. So, you know, the Q4, most likely it's not going to be that huge print as for GDP. But, you know, it was widely expected, at least in my view, right? So, you know, the average for the entirety of 2025, I still think it's going to be around 2%, which, again, it's basically the long-term trend when it comes down to growth for a mature economy like the US. So still, you know, pretty good, right? At the end of the day, at least it's not a contraction. I mean, it is compared to 2021, 22, when we got all the steamy checks, but I think, again, we are seeing the economy normalizing itself. But, you know, as we may see going ahead, risks of further deterioration might be just around the corner, right? This is why I included the data on exports and imports for the month of January. And this is why, you know, I think although the data for Q4 might be grim a little bit, if you look at how exports kept on going higher and how imports, you know, they bounced back up a little bit, but, you know, they picked and now they're coming down. So I think this could be a boost for GDP in Q1 of 2026. So we'll see. Currently, GDP now is estimating 2.7% for Q1 2026. We'll see about that. I mean, I'm not always sure that this is a very reliable source, but these are just projections, right? Getting back to it, what we got then. PCE, which came in at 2.8, a bit high, I guess. But again, still, I think with PCE, which is the favorite inflation gouging measurement by the Fed, still being around these levels and being kind of stable around these levels, I don't think there is a lot of incentive to cut, at least at this meeting, right? So I think at the end of the day, the Fed Watch tool is pretty much on point, and we are not going to see cuts, most likely. So, guess we'll see. It's going to be when? On Wednesday, the 18th, I guess. So, yeah, just a few days in the future. And then what? Let me get back to it. Job openings, all right? Yeah, sure. Which they came in above expectations, sure, but still, if you look at the trend, it doesn't look like a very good trend. I mean, the way I see it, all right? Especially if you pair it up with unemployment taking up a notch, just a tiny bit, NFP negative revision. So I don't think a tiny little bit of a data above expectations could really turn the table in favor of the labor market. Still think it's deteriorating, right? And then Michigan consumer sentiment, which of course, if you look at the last 5 years, still low, still trending lower, especially if you zoom out 10 years type of a view, right? So again, not a lot of good news for consumers. I don't have the chart ready in here, but I mean, just as a thought experiment, the US economy was particularly resilient, right? Because the consumers were particularly resilient. Now, just for the sake of it, I don't have it here, but just go and check the savings rate in the US. There was a huge buffer in 2021, right after the pandemic, because of all the stimulus. And so even if we got an inflationary problem there, those savings, that buffer, helped the consumers to keep on, bidding the market or the economy, so to speak. Now that buffer, it's pretty much depleted. So again, if you pair it up with a deteriorating labor market, a savings rate which are basically not as good as they were in 2021, potentially an energy spike and another inflationary problem, I don't think the economy is in a good spot. Or at least, the risk of a downturn, it's getting bigger and bigger the more we keep on going like this, right? We'll see about that, but, it's just assessing the risk. If I was, pretty positive up until the end of the year, right? And coming into January, these thing in the Middle East, it's changing things around a little bit, as it should be, right? As for the break-evens, we are looking at, inflation expectations, obviously, they went up because of what's going on. But the thing is it going to be a sustained, a long-term type of trajectory, or as many other oil spikes in the future, it's going to be short-lived? That remains to be seen. It depends on a lot of different things. It depends on how the conflict will escalate or de-escalate, how much damage we will see in the oil infrastructure, and of course, the Strait of Hormuz. So, it's a very ever-developing situation, right? So, as for trueflation, CPI ticked up, obviously. PCE, same, ticked up. So, things are moving around because of all the developments about the war, right? Now, lastly, credit spreads, they're, again, grinding to the upside, and we still have that type of a danger looming from the private credit market, which is now really, showing signs of contagion. Now, again, is it like 2008? Well, maybe not the same scale, but the dynamics are pretty much the same, right? It looks like late credit cycle type of behavior, right? So that would be it for the economic calendar. Let's jump into the charts. We start out with the DXY, which, surprise, surprise, came back up once again. Do you remember we're talking about, let's see if I can draw it so it's going to be clear. These range where price was moving in between, right? And the assessment was, look, we just swept the low side of the range. We came back toward the midpoint once, twice, and then we broke above it, tried to pull back into it. And again, if you have a mean reversion and it keeps on going, the other part of the scenario is a full-on mean reversion, some sort of a mirror trade. Like we swept the lows, now we're going to mean revert to the mean. If we can trade above it, most likely we're going to trade back to the highs. And that's basically what happened, right? We took out these highs. So I would assume it was an ideal target for this type of a move, right? And we took out the high side of this current range. Now, is it a breakout? I don't know. I mean, it could end very much like it ended at the lows, right? So it's pretty early to tell. Oh, wait a second. Let me. Okay. Because you would need to see now if, right, as we did in here, if we just fail, come back in, right, and go straight back to the mid, or if we can, have a little bit more expansion, creating an acceptance around these levels, maybe some sort of a rounded retest, range high, and then we keep on shooting higher, right, toward this level right here. At that point, this is a legit breakout of a range. And considering that this range was going ahead since the end of June 2025, 6-7 months of a ranging behavior, when that coil snaps, it might be violent, right? So, brace yourself for a potential spike in the DXY, which, it's not the best. Energy spiking, the DXY spiking, it's double damage for a lot of different countries around the globe, right? So I would say for now, this is it. That there is really nothing else. I mean, again, we have been discussing a lot about the dollar and how beaten up it was, the positioning, the sentiment. And again, it's basically the same playbook as last week's video, as you're going to see. When everything starts to break, or there is this impression or this fear that something is about to break, what are you going to default to? US dollars, right? Cash, all of a sudden, it's not trash. And that specific type of a cash, which is US denominated, right? So I think it's basically the same. And as you will see, other assets behaved exactly the same, reflecting the same dynamics we were discussing last week. So dollars up, bonds obviously down because we need to sell the reserves to buy the dollars, right? So, it's kind of the same, right? Foreign currencies, look at the euro, which, shit, we are back at 114, and I think this low, it's really in danger now. If we break this low, yeah, I think we have a little bit of a structural support below it, in the sense that I'm not expecting this area, let's say, just below 113,800 and 112,600. I don't expect this range to give up as easily as we've seen in here, right? But nonetheless, it looks bearish now. It's just obviously the mirror of the dollar, but in reverse. Same for the British pound. And, see how these two basically broke the same structure together in here. And then they just kept on being orderly distributed down, right? The Japanese yen, I mean, who would have thought? Who would have thought that after the Bank of Japan came in with that intervention, we would have violated the laws which were basically the cause of the intervention? Do I need to repeat myself? The central banks, can really fight market forces over the long run? Guess they can't, right? And again, we are back to what, 160. So, Japan will be hit, as many other nations, Europe, Great Britain, right, by a double whammy of currencies, being hammered and energy being more expensive. So I think if you're worried about the US, you should be even more worried about what could happen in your region if you're not US based, right? So the dollar Canadian, dollar Canadian, all things considered, for now, still in this range, although it looks like, this is start to look like a top. I mean, look at these, right? And then look at these. So you see that basically the distribution pattern, it's kind of the same, or it's very similar, right? So if we lose this base in the Canadian dollar, right in here, the first level of support would be, would you count that? Maybe a tiny bit, maybe below this one. Kind of like that, tiny little bounce in here, maybe, but I think all things considered, we are going to get back into here, right? So this one was relevant in the past, in here, and then on the opposite side, in here, broke above it, retested it, up we go. So I think if we start to break and confirming this apex, we might have a bounce in here, an apex retest, and then down again. So assuming the DXY keeps on being particularly strong, I would say this one will break too. The Swiss franc, basically the same pattern. So what you could expect for the Canadian dollar is basically what you see in these. Same distribution pattern. And then we break kind of the apex in here. We break this base. We retested it. And then down we went. So, at the end of the day, if you zoom out enough, it's not to say that the Swiss franc, it's not behaving well against the US dollar, but it looks like this is a short-term top for now. And we'll see how we react around these levels. And again, we spent a lot of time building volumes in here, so these should be a pretty solid base. The first thing would be expecting a little bit of a reaction here. But on the other hand, it would be pretty telling if we just smash through it, because that would signify a lot of weakness in this currency, which again, it's been particularly strong against the dollar. So if you see it completely giving up, it means that the problems in the monetary system, or again, in the currency market, all right, might be even bigger than what you could think, all right? As for the rest, the Chinese yuan remains pretty much intact for now. This bullish trend, it's still there, kind of like the Canadian dollar. It's kind of similar, right? South African rand just gave in this week, right? As you can see, came back down. But again, it should be at support. Preliminary support was in here, right? It is some sort of a breakout tag, like we broke out of the range, quick retest, and then up we went. So as soon as you retest the area, you expect a little bit of a reaction. We got it, but again, it was just short term. We just tested back into it. As for the breaking point, and down we went again. So I think now we might test back into this level and most likely below it. Brazilian real, it was looking like it was holding up, but pretty much the same behavior. Old support, test into it, initial reaction, failure, new highs, and down it went. Russian ruble, it's coming down. It was weak already last week, so we are just seeing continuation. Australian dollar, it looks, with the only difference that in this case, you have higher highs, right? Getting into what seems to be a little bit of an attempt of breaking this base right in here, right? One time, two times. It's the third one, the charmed one. If you are bearish, of course. Maybe. I was saying it looks a little bit like this the Swiss franc or the Canadian dollar, but in this case, the highs are, always higher and higher rather than, as we've seen here, lower and lower. So maybe, but again, it looks weak now. Because, you test back into an old area of support, you actually get the bounce you wanted, and you fail the continuation, which means that inventory, which was picked up in here, wasn't enough to propel price even higher. So if it wasn't enough, we might need to seek buyers lower, right? And then what? Indian rupee. I mean, is it a surprise? Guess not. And I spent a lot of time talking about it, so I'm not going to repeat myself. Let's have a look instead at gold. So gold had a week which started out good. Like, we immediately tested back into the support again, and we bounced off of it. But again, we just filled this inefficient leg down, and we were rejected here. So again, at this point, this expected support, right, tapped, generate a reaction, but it's not enough. Tapped third time. I don't know. But again, I think if you start to look at all the things together, it's basically a copy pasta of last week, right? When the dollar screams higher and liquidity becomes the predominant need in the markets, you're going to sell everything you have in order to get the liquidity you need, right? Sell the metals, sell the stocks, sell the bonds. It doesn't really matter. We have more pressing urgencies to satisfy and to meet, regardless of what may be your long-term fundamental case for whatever other asset class, right? And, the other metals, so silver, copper, and I got copper 2 times in here, I see. Palladium, I should have platinum in here. All right, but I mean, anyway, it's pretty much the same, all right? So the levels are pretty straightforward, right? Just looking at silver for an example. We came back into this old level right here, pushed into it, rejection to where? Old level of support, right? Before the run up, we built up this base, and basically same as gold. Tapped into it once, twice, failed rally, back down we went, right? So it's kind of the same type of pattern as we've seen on gold. So it's just the same. As for yields, again, yields spiking up. And you might say it's because of inflation. It's because the market is expecting inflation to go up because of the energy spike. Yeah, but most likely that is a component. But again, I do think you need to, I guess, the nice part would be trying to assess how much of these rallying yields that you're looking at is driven by the inflationary scare and how much is driven by the liquidity needs. Because, although they do bring the same results as for yields and conversely bonds, implications might be different, right? So, I think sure that it is a problem because yields would spike and, you're going to have the camp which is telling you it's because of the deficit, it's because of the debt. Now that we started a war which is costing us what? They estimated 11 billion in the first week. So they're saying the deficit will be even bigger than what you would expected because of this war, and therefore foreigners are going to demand a higher premium in order to buy a debt. Yeah, well, yeah, maybe. Or maybe the story is just about, yields should go up because people expect inflation to go up. So in order to hold a treasury bond, if you expect inflation to go up, you want to be compensated a bit more. Otherwise, you're not going to hold the bond. So, you sell the bonds because you think it's a losing proposition, right? And maybe you'll buy back in if rates go high enough to make it, a considerable proposition, right? I think, again, both are valid. I'm not really arguing or cheering for one or the other. I think they're both impacting the market. And I would just say, don't marry one or the other, but just be aware that they're both playing a role, right? So whether you think this is US bearish over the long run because of the debt, the deficit, and all the rest, or, you could say, well, I mean, to some degree, isn't it USA bullish, in the sense that, once again, we are seeing that although you may think the dollar is dead and all the rest, when it comes down to it, people still want our dollars, right? And if they want our dollars, that means we are still the reserve currency of the world, which means we still have a very huge leverage on the rest of the world, right? So, it gets a bit more complicated than that. Of course, I don't want to spend half an hour talking about the implications for the monetary system and the financial markets. But, just my invitation would be to, just not looking at things and thinking that they are just black and white. There are a lot of shades of gray in all this topic, right? Now, let's get into the real big topic for the week, which is oil, of course. Now, I'm looking at the hourly chart in here so that we can just look at what went on over the last 2 weeks, right? So, of course, we got the initial spike because of the war, and then the war escalated. This week started out basically with oil pumping and spiking up to 120, more or less. And then we spent the rest of Monday, well, pretty much giving it all back and getting back to this level of support, right, at and around 82. We bounced there, and then again on Tuesday we came even lower, testing back in here, right, 77. So that alone should give you the perspective on how much political premium it's built in this market right now. Of course, a lot of news are driving this market for now. All of these, I guess, came on the back of the US announcing that they were, joining the International Energy Agency intentions of releasing a lot of oil reserves into the market in order to tame price. And therefore, maybe just talking about it convinced a lot of speculators to just, sell those positions and take those profits after the spike. But then again, thing is that, the war kept on escalating. Things didn't de-escalate. And so the market kept on, grinding to the upside. And, if you look at the levels, right, it did it in a very technical fashion. Like, I mean, if you remember the DXY, right, look at this one, right? Doesn't look like the same, right? We have some sort of a range, swept the lows, came back into it, back to the middle of it, back to the highs, breaking the highs, confirming the retest of range high as a breakout, and up we go. That would be just one thing. But even if you look at very basic levels, as you can see, they're pretty much respected. Not to the T, maybe, but, as an area, if you imagine them as an area instead of as a line, I would guess they're pretty much respected. And now we are back into here. I think there is a lot of sparse liquidity in here. I mean, there was a lot of volatility, of course. So I would say, liquidity above these levels is a bit scrambled, I think. We could, I mean, I know these are just futures, but what if you go like these, just for the sake of it, before the spike, something like that could be, right? Yeah, as you can see, there is not a lot of volumes were put in at these levels. So if we really want to rip through it, yeah, I would say there's space. There is a lot of, call it a vacuum, call it whatever, but there is a lot which could be built in this region that we don't have yet. So, it depends a lot on what's going to happen. I was reading that just tonight, and remember, this is Saturday morning over here, and it's almost 10 a.m. in the morning, considering we got now 5 hours difference with, Eastern time in the US, still night in the US now. I was reading that just this night or yesterday for me, the US bombed a particular island. I don't know how to pronounce it, Karg Island in Iran, which is a major oil hub for, import and exports of oil. I would say more than anything exports. And they bombed all the military facilities there. And the threat is to come back and starting to target oil infrastructure, and therefore crippling the ability of Iran to export oil, which again, I think is another sign of escalation because, well, who tells that in retaliation to that, Iran is going to escalate it even more and starting to target all the oil infrastructure of all the other countries in the region, like Bahrain, Qatar, Saudis, right? And then what? Do we just reciprocally bomb all the oil infrastructure we can think of? And then even if the conflict ends, how can we extract and export oil? So it's a damage for us because we are not going to be able to count on those revenues, but it is a major problem for all of other countries which were relying on our exports of oil for their energy needs. And remember, it's not just about energy. Oil, it's used in a lot of different industries. The chemicals. Think about all the plastic thingy you handle every single day. You wouldn't have plastic without oil. So, it's not just about the energy. All right. Now, speaking of oil, and if you want to add a little bit of a taint of conspiracy theory or spy games or whatever, since I think all of this is about China, right? Now, there were rumors about China having a little bit of a shadow stockpile, which is supposedly offshore, but, near enough Chinese shores to be available if they need that. And again, it looks like, do you remember all the talks about the Russian shadow oil fleet and all the rest? It looks like the Iranians had their own, and, China, bottom line is they should have a buffer, right? So even if they are cut off from the oil supplies, they could go ahead for a little longer than what people may estimate, right? How long? I don't know. Could be a month, could be 2 months. I don't really know. But again, I think this is the big game at the end of the day. Like, again, I don't necessarily want to get political, but especially where I do live, I hear a lot of people saying, well, I mean, the orange man is mad. The orange man is crazy, man. He doesn't have a plan. He doesn't know what he's doing. Every single morning he wakes up and he tweets a different thing. Well, okay, maybe. I mean, you may also consider that cows might be part of the strategy. But again, do you think he doesn't really have a plan? I mean, maybe it's not a plan that he came up with. Maybe it was just the right person, so to speak, quote unquote, right person at the right moment to execute a plan because he doesn't have a lot of political capital to lose. I mean, he's not going to be elected anyway. So if not now, when? And what if the old Make America Great Again, it wasn't about the American population, but it was about America as a country? Oftentimes, I think we are misleading to think that what a nation or a government does, it's necessarily a reflection of what the citizens would want. And I think there is a huge difference in American people and the American government. Same as I think there is a huge difference in every other nation government and their own people and citizens. It's always the same for me. I'm not putting Americans or America in the hole. It's just the same, right? You are not your government. and your government, it doesn't necessarily make your own interests. So, it gets a bit tricky there. But again, I think everything we've seen is about China, right? If I had to guess, like you go into Venezuela, right? But then, wouldn't you think that someone would have tapped the president on the shoulder? Look, so even if we take out Maduro, those oil fields, they're not going to be operational because, they are in such a state of decadence that our companies like Exxon or Chevron, they're telling us it would take billions of investments to commit in order to get them back to an efficient enough level to produce a good enough output to justify the investment, considering the current price of a barrel of oil. And your answer? Doesn't matter. I'm not planning on actually getting the oil. All I care about is that China doesn't have it. And then you go in Iran. And again, people say, we should stop waging these war, masking them as exploitation of democracy, while instead you just went there for the oil. Really? I'm the first oil producer. I don't really care to get that oil necessarily. All I care is that if I can't get it, China cannot either, right? And then what? Man, you look at recent dialogues in between the US and Russia, and the US also hinting at the fact they might lift international sanctions on Russian oils. What would you think would be the caveat for that? Dear Mr. Putin, we may allow you, and we could pressure our allies in Europe to get back to buy your gas and oil so that you don't have to sell it on the black market at a huge discount to China and India. But the caveat is that if we lift the sanctions, you are not allowed to sell oil to China. So now you cut off China from supplies of oil from Venezuela, Middle East, and now Russia. Again, will it work? Is it a perfect plan? Will it backfire massively? Maybe, possibly, but saying that there is no plan, I mean, I don't know. It's like you don't move so many things. You don't start so many things if you don't have at least an idea of what you would like to achieve. And again, when people say we are winning, we are losing, winning or losing, it depends on the goals that you had before actually starting the entire thing. Like if the goal was exporting democracy and freeing the Iranian people from the regime or changing the regime, yeah, well, you're losing. But what if that wasn't the goal at all? And who cares about what's going on with those people? If they want freedom and democracy, well, they should better get that for themselves, as the French did in 1789 with the French Revolution. Plus, who the fuck says they do want democracy, right? So, I mean, I guess it's about that. Now, again, just a little bit of a conspiracy theory or risiko game plan, whatever, but I thought it was interesting. And then, getting back to more interesting things, people now say, well, look, we got the spike, we got a pullback, but it looks like now oil is reaccumulating and it's ready to keep on going higher. You could look at what's going on in the oil curve. Now, you do know that, that there are futures on oil and they all have different expirations, right? There is one for every month, I guess. So as you can see, here we got a representation of the curve. So the curve is just the visual representation of different prices that we got for each different contract, which reflects each different expirations down the road into the future, right? So it looks like, again, although we are pricing in the April contract at 100 right now, I mean, the screenshot was taken throughout the week. Now we closed at what? 99, so pretty much we're there, right? But let's say what counts is that the more you go into the future, the less or the lower the futures market are pricing in oil, right? And if you look at December, so the end of the year, they're pricing it in at 73. So what does it tell you is that, sure, I mean, the market is just thinking that this spike is going to be temporary. And in the future, we are going to look at lower oil prices. Although this orange line right here, if you check, that refers to 2 weeks ago, which is basically before the war. So it's true that the market thinks that this spike might be temporary, right? But it is also true that the market is expecting overall, as a base case, as a baseline, oil prices to be structurally higher compared to what they were before this conflict, right? In both situations, whether now or 2 weeks ago, they were always expecting oil prices to be lower, right? But, there is a difference if your starting point is 100 or if it was 66, right? So again, which is why, again, I've always said, especially in 2025, I think there is no fundamental case for oil prices to be much higher than these, but, war actually changed the plot a little bit, and then we've seen the charts starting to develop in a way which was telling a different story, probably on anticipation of what was going on. So, now what you see is that the curve, it's basically what it is defined as backwardation, when basically the contracts down the road are trading at a lower price compared to, the current contract up front or, the spot price, right? And, usually normality would be that you have contango. So that curve would be inverted, which means that the more you go down the curve into the future, the higher the price of oil should be. For a simple reason. If I'm buying a contract now to get oil, not tomorrow, not next week, but, I don't know, October, November, whatever, well, in that price that I'm paying now to get oil then, you should factor in the fact that the person which is selling me that oil now for then will need to store that oil for me since the moment I get the delivery. And those storage costs, they're going to be factoring in the price I'm paying now. So again, normally you should have contango in a normal market. And that goes for oil, as I would guess, for a lot of other different commodities, right? So now, if you think about that, again, getting back to this pattern of reaccumulation, you could then check something like this. Now, what you see here, it's basically the spread, all right, in between the current contract up front and the next contract up front, right? So imagine it as CL1 exclamation mark minus CL2 exclamation mark. And, you see that the spread went up, right? And again, we're not talking huge amounts, but it is just a spread. So if you have a spread, if your spread in between the current contract up front and the next, it's going to be around $6, it means that they are expecting to see oil prices to be higher into the future. So it went up, then immediately it was reabsorbed, and it came back down to $121, right? But as you can see, it's starting to go up again, all right? And the same type of behavior you can observe in what is defined as the calendar spread. So the current month up front, which would be April, I guess. I mean, should I check? What's the current one? CLJ should be, I think it's April, but yeah, J, April, yeah, okay. So, the calendar spread is in between the current contract up front and the December contract. CLZ is usually stands for the December contract. And as you can see, same, although in here the spread was even crazier. Why is that? Well, again, we are talking about December, 8 months, 7 months down the road. You need to factor in storage costs and all the rest, so the spread is going to be even higher than what we were looking at in the other type of spread, the prompt spread, right? But again, same behavior, went up massively, then came back down, and then it looks like, again, the spread is widening a bit more right now. So I think at the end of the day, we should expect higher oil prices or oil prices to stay at relatively high levels for now, up until the point things in the Middle East doesn't de-escalate a notch. And I don't know how they could, at least for now, based on the news that we got now. But again, who knows, right? And into the future, maybe we will see oil prices taming themselves after the situation de-escalates. But again, now. So one thing is the geopolitical premium. The other one would be the problems that we got when oil prices going up, creating a big enough damage in the economy and killing a lot of aggregate demand. So, for instance, if you check this one, so this is basically, recently enough, since the 90s, right? This is what we've seen every single time the oil curve that we were looking at before went into backwardation. So, yeah, sure. Initially, we got an oil spike, yeah. And then what? The infamous gray shaded areas, those are all recessions, right? 89 or the 90s, basically. Then again, in here, 95, 2000, 08, and, even after that. So you see how many times the curve went into backwardation as for oil, and what happened next to the price of oil. Because sure, if you trigger a massive recession, what do you think is going to happen to the price of oil? Well, you kill demand. And if you kill demand, there is no need for, additional oil. And price just collapses back down. So, will it happen exactly the same this time? Or, does it need to happen from these levels? Or would oil need to go at 120, 150 or whatever? Like Iran is threatening to bring up the price of oil to $200 a barrel. Maybe, I don't know the future. It's just like, you don't know how it's going to get there, but if it gets there or close enough or past there, these are the historical consequences. And they're not pretty, of course, but at the same time, they don't necessarily indicate sustainable and long-term and persistent inflationary pressures, right? So again, I think that's where I would leave it with oil. It's going to be interesting to see what's going on. So let's close in this initial part with Bitcoin, which, again, particularly resilient, all things considered, still going into this range. And if you do remember, expectations were a bit neutral for this week. We've seen this area at the end of the day, this sort of a base holding. We had the bounce, got back into the same level, right? Exactly the same. A little bit of a rejection, but again, it is also true that at least for now, in the very short term, it looks like you're trading on higher lows. For now, you are still creating, equal highs in here. So again, is it some sort of a reaccumulation, right? Which again could be just like these, right? Some sort of a rounded reaccumulation like these, or it is just normal ranging behavior. Market, it's a bit undecided, and we again, I'm stupid, yeah, and we end up repeating this sort of pattern right here, where we need to trap in enough longs to then liquidate them in a very dramatic fashion. I don't know. Look, the chart for now, for me, again, they keep on being particularly neutral. Fundamentally, I would say, look, again, on the back of what we have discussed so far, if you think oil would drain the liquidity from the rest of the system, because, again, you need to keep the lights up on, okay? And if you need to keep the lights on, you're going to need to buy the oil. If oil goes up, you need more dollars to buy the oil. If you don't have the dollars, you sell the treasuries, you sell the stocks, you sell the metals. So people always said that Bitcoin is a very good liquidity barometer. So if I expect a period where liquidity might dry up, would I expect Bitcoin to be massively bullish and decoupling itself from the rest of risk-on assets? Quite honestly, no. If it's driven by liquidity, and I expect the liquidity to be all sucked up, but by what's going on in the energy market and what's going on with the DXY, not to mention private credit. We might hint at that later on when we talk about stocks, but private credit, if you have cracks in private credit, does it increase or reduce the perceived counterparty risk and therefore the willingness of money dealers, shadow banks to extend loans, aka create an expanded credit, which again, credit is money in our system. So would you expect more or less liquidity? I would expect less. And since this is a liquidity barometer, I don't know, to me, it's hard to be full on bullish on this one right now, which is why I'm neutral at the end of the day, as I was last week, because although there are a lot of risks, I think a lot of the damage in Bitcoin has been done, right? If you look at what happened recently. So could it go lower if we have a credit event or a liquidity crisis? Sure, it could go lower. I just think that many people already de-risked or moved out of their Bitcoin holdings. And now it's time, if you really need to stock up liquidity, I mean, you could set gold, assuming you're in from a hell of a lot lower. Why would you sell Bitcoin, which is already dropped a lot, while you can sell gold or silver or whatever, which would make you a lot more money than just selling Bitcoin at the recent lows, assuming you still have the Bitcoins, right? So yeah, I'm not bullish, I'm just acknowledging the fact that it's getting a bit neutral compared to others assets. But again, I think it's still a risk on asset, all right? So that would be it. Let's have a little bit of a break and then let's get back in for the stock market. Now, the stock market, obviously, it wasn't immune to what's going on. Although, we gapped down on as soon as we opened, obviously, because of what was going on. Basically, if you wake up and oil prices are gapping up to 110, 120, the stock market gapping down is what you should expect, right? But we spend the rest of Monday basically coming back up. We filled the gap, and initially, obviously, as you would expect, there was a tiny bit of rejection, both on ES futures, again, to some degree, even NASDAQ futures, right? Pretty much. The Dow was the weaker in this case. As you can see, it really didn't feel the gap at the first pass. It came in shy of it. All right. So the relative strength is already pretty early in the week started to tilt toward NQ, which, again, a little bit of a spoiler alert. I think it makes sense. I think we are, as I said, I'm expecting another, before everything is said and done, I would expect another type of rotation, from quote unquote value back to growth, right? Will it be temporary? Will it last for just 2 weeks or 1 month? Maybe. But again, since the market is being particularly rotational, at the end of the day, I would expect to see the same once again while we get more and more toward the summer. Although, overall, I would expect general weakness in the broad markets because of what's going on, right? But again, I guess, one thing is having all the markets, all the sectors, all the factors liquidating at the same time. Another thing might be, you see this week or this month, we had a lot of weakness in technology and financials, but the rest of the market, which is not enough, obviously, if you look at the market cap comparisons, but hey, that pumped actually. So maybe your utilities, your defensive stocks, whatever, your real estate, right? Your energy component. So overall, yeah, the market came down, but it wasn't a flush, right? It was more of a rotation. And then again, if we have the opposite rotation, so maybe you see those sectors which performed particularly well over the last month or two getting liquidated a bit, but the other side, which is particularly oversold, like tech, software and whatnot, they might catch a bid. You might see the market overall keep on drifting down, but not really having that flush. We'll see about that. But I guess it depends a lot, again, on liquidity conditions, on geopolitical news and whatever. But, getting back to it. Tuesday, it was pretty much a ranging day. The market kept on grinding to the upside on all indices. And it kept on going like this into Wednesday. Quite honestly, gotta say, these markets, when you got these two tape type of market, intraday, they are, look, on one side, they might be frustrating, right? Especially if you have a strategy where you would like to capitalize in a trending move or in a trending session, right? There is a lot of back and forth, right? But the ranges were really, really wide. So even intraday, there was a lot of opportunity to, to do good on both sides of the tape. Now, sure, these are the type of markets. When you see the market starting going like this, then you know, if you are a day trader, that you shouldn't ever be too married with your positions. So scalping becomes a play, or, mean reversion plays, intraday. Those are the plays in this environment. But again, it was 2 days. And then on Thursday, we had, the market coming back down, testing back. And again, look how many times, if you look back at the beginning of the video, currencies, to some degree metals, look how many times we have the same pattern. Market goes up, creates a structure, creates a floor, it breaks the floor, tests back into it, and down it goes, right? I mean, it's kind of always the same at the very end of the day, whether you're looking at a 30-minute chart like this one, or whether you're looking at a daily or weekly chart, right? The fractal nature is always there. So Thursday, especially in the New York session, was all down. And yeah, in the end of the session, we started to consolidate a bit. And, Friday, we attempted a bounce, especially in the London session, beginning of the day, overnight, for you Yanks out there. But we closed the week really, really on a very negative posture. And again, having a close where the closing price is basically the lows of the day, it's not cool, right? So look, this is what you get if you zoom out on a daily time frame. And I guess, this is why I was thinking about NASDAQ maybe seeing a little bit of rotation, right? Because although both ES and NQ came down, if you just look at the current, call it range or structure, whatever. Let's do it like this. If you look at the current structure, like from here, let's say to maybe here, right? Are we attempting to break it? Yeah, sure, but we are still kind of there, right? Instead, if you try to plot something similar on ES futures, you end up with something like this, right? Where you had this type of structure, which was basically the same, right? Price ranging in between these levels. It looks like we are a bit ahead in that process of creating a dealing range. And again, breaking it, testing back into it, we're going down. So, although, ES futures were holding up relatively better than NQ, this is another type of behavior which would lead me to believe that, in relative terms, you might see a little bit of a rotation where probably, right, both of these indices would keep on drifting down, but one would go, faster to the downside compared to the other, right? As for the rest, we've seen the same behavior in the Dow and in the Russell. They both topped out. So, this is pretty much risk off, in my view. And I think, what if you would start to think about targets? Well, look, for the S&P, for ES futures, right? I think there should be, at the very least, a good level of support here. Tested twice already, but again, up until the point it is support, you should keep on treating it as a support. Kind of the same for NQ futures, although, you could call it this one a test. 1, 2, almost 3. So again, would you expect the market to keep on holding this level? To me, it's always the same. Up until the point it doesn't break, it doesn't break. So I would be cautious, being particularly bearish when we get back into support. And then if we break it, well, it's kind of the same, right? If we break it, we might retest it and then coming back down. So I would expect a market which will keep on being some sort of a two-tape type of market. So for instance, we open up on Monday, especially if we gap down, right? Let's say we gap down in here, right? Oh, it's white. Go back to black. We gap down in here. I would expect a little bit throughout the week. It doesn't have to be on Monday, but I would expect a little bit of a bounce, right? And then potentially rejection and continuation, if that's the case, right? So, at the end of the day, it's nothing different than what we've seen this week. We opened right in here, gapping down. We kept on pushing, and then we just failed, right? And then, okay, redistribution, and down we go again, right? Now, look, if you look at these other layout, at this point, again, another reason to be, cautiously bearish, if you want to be, is that we are sitting on the 200 days moving average, which is usually long-term support. So again, could we break it? Well, maybe. As you can see in the past, we can break it. We're testing it from from above and keep on drifting lower. Same as, once we reclaim that was the green light for the massive rally. And the QQQ was basically the same, right? So again, I would treat it as support up until the point it's not. So now you have structural support. You have a very important moving average. You might not care about moving averages, but I can tell you, algos, they do. So, it's some sort of if you think about CTAs, so computer trading algorithms, it's one of those things where they are programmed to, start a buying routine when price approaches these levels around the moving average to 200 days. As you can see, a lot of times, especially in NQ, they bought this region. So the question becomes, okay, now what? If we break below, let's say we go like this, right? Then what? Then they will trigger a selling routine, and every rally into it will be sold up until the point we leave below it. But same for this one. Let's say up until the point we leave above it, algos might buy it, right? They are planned to buy it. If for some reason we break below it and this starts to be a negative tape or a bearish tape, the algos will shift from being buyers to be sellers. So every rally into it would be an opportunity for the algos to sell the market down. Plus, on top of it, you might want to check the VIX because there are a lot of machines which are programmed on a volatility base, which means, let's say a volatility, it's going lower or it's staying lower, keep on buying, right? If you have a program which is running a volatility risk adjusted type of a strategy, it might be that the more volatility picks up, the more the program, the routine, it's going to be a seller because they are trying to de-risk based on current volatility. So, there are a lot of things to consider here. For now, again, what we've seen is that to end up the chapter on moving averages, we are seeing markets now leaving below the 100 days in white, which again was another thing which was used as support on the way up. And now every time we tested back into it, it was used as resistance. So imagine the 200 days playing the same, right? It's support up until the point it's not, but when it's not, you might expect something like this. Very short-term moving averages like your 21, your 55, they are now crossing down. They are crossed down and downward sloped. So that would indicate momentum accelerating to the downside. Still, daily, Okay, so don't expect things to massively change just in one session. But sure, this is not a time to be brave and bold. All right, it's more of a time where you should manage your risk if you didn't already. And again, do you remember when we were talking about, look, all those people on the internet which are telling you the market is going to drop 50%, it's going to be another 2008. What was the thing there? Look, maybe they're right, but just because they may be right, that doesn't mean that the market won't give you opportunities to the risk, to bring home money, to bring home profits, and go on a much more cautious type of approach. Again, this is one of those moments, right? I mean, you see the market breaking the 100 days moving average, right? All right, it was support up until this point. How many rallies the market gave you to the risk? Oh no, I'm still holding my positions and the market broke. Oh, okay, the market got back into it. What do? Well, 1, 2, 3 days, and the market can't reclaim that moving average, is actually using it as resistance. You know what? It might be this is my opportunity to actually trim a lot of my positions and cut a good chunk of my exposure, right? And the market gave you that opportunity once, twice. I mean, if you want to count these tiny little spikes, 3 or maybe 4 times. Same in here, right? The market gave you the opportunity in here, or maybe just this week, it was when the market gave you that opportunity. Did you take it or not? If you took it, you should be pretty much relaxed. If you put money on the sideline, maybe you put them in a money market fund so they don't lose against inflation, supposedly, or at least in the very short term, and you are preserving your dry powder to maybe buying the dip. Let's say the market pulls back another 10%, right? And then, after the summer or during the summer, the situation in the Middle East is resolved, you got money to put at work, right? So this is how you should approach it. Tops, especially like these, rounded tops, they don't really see the market crashing all at once. It's not a liquidity event yet. So, you may still be in time to the risk if you didn't already. Then again, it's up to you to assess your own probabilities of this market actually being topped out and being, due for a further pullback. Or maybe you might say, you know what, didn't the risk, and we are now on the 200 days moving average, so I think I'm actually want to be a buyer here. Who knows, right? Which again, it would be a good point to manage risk, right? It's kind of like the same it was in here, right? You buy it, bounces, all cool. You buy it, it cracks it, shit, you're underwater. But hey, look, gets back into it, you can mitigate your loss, and at the end of the day, you played the game with a minimal risk, or you got your chance to get out with a relatively small loss. So who knows what's going to happen at these 200 days moving average, right? So I guess closing in, what we got, a little bit of seasonality. We went over it last week, but just for the sake of it. So mid-March should be when the market bottoms for the period. Although again, as we looked at last week, it is an election year, so a further pullback is in the cards, especially throughout the summer months. And then after we got the actual elections, in the end of the year, might be even a better period to put money to work, right? As for the positioning, what we see is that, people are starting to the risk a little bit, right? And therefore, it looks like even retail, which were always buying the dip, are they throwing in the towel? No, towel. Yeah, throw a towel if you can. The towel, right? Potentially, maybe they are looking at things which, one thing is well, the retail, it doesn't know about liquidity, it doesn't know about private credit, it doesn't know about shadow banking. Yeah, maybe. He knows about a war, he knows about oil, though. So maybe this could be the thing which generate the fear, even in the retail investor. And at this point, he won't beat the market. He won't try to buy the dip anymore, right? Who knows? What else? Risk appetite came down a notch. Of course, why not? And speaking of retail investors, if you look at the SPX activity, it looks like, over the last 2 weeks, they weren't major buyers, all right? So again, you see in blue is that what they usually buy as for the Mag 7, right? Which, there was a little bit of a buying activity there, but compared to what it was previously, not a lot. In gray, you should see the AI 30, so I guess that would be the other AI-related stocks, excluding the Mag 7, which was, still positive even this week. But the rest of the index, the other 470 stocks, as you can see, they weren't bidded, right? That is negative territory below the zero line here. So again, might be even the retailer pulling back a bit. Now, just a tiny little bit of a parenthesis on the credit markets, especially the private credit. At this point, if you didn't know, when it was just about tricolors and others, subprime lenders, and then there was Blue Owl, and then there was the UBS fund, and then we got the other fund in the UK, MFS or whatever. I mean, at this point, you should know, because even the big guys are starting to report exposure to these private credit debacle here. I mean, now we're talking about Blackstone, BlackRock. Well, I mean, we got Cliffwater, but Morgan Stanley, JP Morgan Chase. I mean, look, it is kind of always like that, right? When there is one cockroach, usually there are many. And the thing is that initially, what do? It's always the same playbook. Oh, well, no, we are insulated from this problem. Are you? I mean, all these banks' balance sheet are interconnected to some degree. Like in this case, let's say this is the playbook. Now, let's say you have an idea for a business, right? But you don't have the money. And it might be a risky business, which you don't know how many money you will make and when or how long it will take for the business to start generating revenues. So you go to your bank, you go to Wells Fargo, you go to JP Morgan or Morgan Stanley, and you ask for a loan. They're going to look at you, they're going to look at your credit score, and they're going to tell you, you know what, pound sand, we are not going to give you money. You are too much of a risk. So what do? You go to another entity, which is going to ask for a loan to JP Morgan, Wells Fargo, and whatever, because he got a very good credit score. And then with that money, he's going to lend the money to you, charging you a wider interest rates compared to what he's paying to the big banks, so he can pocket the spread. The thing is that if and when you default, or if and when your great idea for your company is starting to be shit, and the market realizes that, now you can't make the subprime lenders whole. You can't get the money back. But if you can't, nor the subprime lender can give the money back to the big banks, Morgan Stanley and all the others. So at a point, they start to see holes in their balance sheets. And what do you think is going to happen next? If you have this type of issue, if the collateral is not good anymore, because incidentally, what was the collateral for all those loans? For the loans themselves, right? So, it's kind of always the same late stage credit cycle type of behavior, in my view. And if the collateral is questioned, what do you think is going to happen to the willingness of banks to extend credit, aka liquidity? Or that should lower the liquidity availability in markets. So, this may be another thing which you add on top of the situation with the energy problem, the war, the geopolitics, the labor market deteriorating, and of course, valuations and all we've seen, right? And, I think it's always the same. How do you get, look, assuming we get there, I'm not saying we necessarily go there, but assuming we transition into some sort of a downturn, recession, or let alone crisis mode, whatever, how do these things usually develop themselves? It's like, do you remember that quote from, I don't remember the book or this, the anecdote now, but it was along the lines of, there is one guy asking the other guy, well, mate, how did you go bankrupt? And he goes like, well, slowly at first, and then all together. I think it's kind of the same. 1 cockroach, 2 cockroaches, 3, 4, 10, 20. Now big cockroaches. And when the tide goes, now you really see who's swimming naked, right? But I think, this is one thing that at the end of the day, whether you like it or not, it could impact the entire market because liquidity drives all, right? Now, I found this one. I don't really know how much I would believe in it. Like historically, yeah, you see, there is a statistical truth in it. When these two lines, the tech sector and the energy plus material sectors, when they do diverge a lot, more often than not, as I always say, what's the biggest force in financial markets? Mean reversion, right? You see it playing out in 2008 in the dot-com bust. And, are we looking at the same thing now? So we should expect, from here on out, structural higher prices in commodities and lower valuations in tech. Maybe. I mean, sure, it happened in the past, so why shouldn't it happen in the future at a point? I guess the thing is always timing it, right? What if it happens, but it's going to happen, I don't know, 2-3 years from now? Do you sell all your tech stocks now? And do you buy all the potential commodities you can think of now? I mean, I guess, yeah, one thing it's predicting, but without a timeline, it's, I don't know, to me, it's always kind of pointless. It's like, again, good old things. Oh, the market is going to crash 50%. Yeah. 10 years down the road. See, told you the market would have crashed 50%. Yeah, sure. But over the last 10 years, before crashing 50%, it went up 300%. So, I mean, it's like, told you, yeah, sooner or later, right? It's like forecasting. It's like predicting your own death. You're going to be right at a point, but it doesn't really matter if you are out, if you're messing around with the timing, right? So again, and, closing in to wrap things up, dollar, right? And I'm just including that because just yesterday I had these, it was some sort of a talk, some sort of a meetup online with other guys, friends, most of them US based. I think one was from San Diego and the other one was, can't really remember. I think Houston, maybe. My memory is really fucked up. But again, they were American based. And, we were discussing about the opportunity for, Americans, or United States based people or entities to keep on investing international or domestically. And, my argument has always been, look at the dollar, right? If you want to decide, because, we had that theme about sell America type of trade. We were looking at all the indices in Europe, mainly, like, the DAX, right? Or the FTSE, or the CAC 40 in France, the IBEX in Spain. This one should be my own. The FTSE maybe in Italy, right? Greece. No, this is not Greece. This is the Netherlands, right? This is Greece, right? Poland. But they were all outperforming the United States benchmark, right? Sure, but over a long enough period of time, like if you look at the DXY, right? And if you go, let's say, I would need a monthly scale for it, I guess. Yeah, something like that. All right. Now, look at the monthly scale of the DXY. Since basically 08, 09, 010, it looks to me like the trend is up, right? Why does it matter? Sure, you can have these massive pullbacks, sure, but if you're really looking at the long term, right, 5-10 years down the road, I think this is not something you should discard. Because of what? Well, in my view, because of this. It is true that when you have the DXY going up, that kind of erodes the revenues for the S&P companies. A lot of them are international. I mean, they are multinational. So roughly 40% of their revenues is generated outside of the US. So, if you have the dollar going up, when you have those money coming in from the outside and you try to translate them in dollars, they should equate to a lower revenue for you. And, a stronger dollars actually discourage people from buying US made stuff. But at the same time, it tames down inflation a little bit because commodities get cheaper if you are pricing them in dollars. But the thing, again, is that especially when you look at emerging markets, they tend to benefit a lot from a weakening dollar, right? But they tend to be hit by a strengthening dollar. So when you're thinking about investing and moving money out of the US investments into the stock market in Asia or whatever, just, assess what do you think the DXY is going to do. Or if it's not the DXY, just look at the relationship in between the dollar and the currency denomination of the investment you would like to put your money in. Because, those currency fluctuations are going to play a major role into it. Not to mention, different taxation regimes or different regulatory framework. One of the examples was, look, at the end of the day, whether you like it or not, when it comes down to rule of law, the US are still relatively safe, right? You are a US citizen, you can count on the rule of law in the US. Would you say the same about putting money in some Chinese assets? What do you think happened to all those people which are holding investments in Russia when they were confiscated by basically the EU and the US? Or conversely, what would you think would happen if all of a sudden, let's say a country like China would decide to nationalize an entire sector? Would you think you would be able to start a class action against who? Against the Chinese Communist Party or Xi Jinping? I guess not. Again, Venezuela was in the news, right? A lot of people which invested in the Venezuelan energy infrastructure, those sector was nationalized 2 times over the last 15 years, I guess, if my memory is serving me correctly. So there are a lot of risks in investing abroad. Plus, again, last but not least, think about projected growth or expected growth. Like the IMF is projecting, just for comparison, the US to keep on growing around 2%, which is basically what we are looking at right now. The Eurozone, it's forecasted to be growing at and around 1%. So why would you put money into the euro denomination if it's going to grow half of what you in the US are expected to grow at? Plus, if you keep on thinking this trend, it's going to maintain itself, and we are just working on a macro higher low, all things considered, what do you think is going to happen to the euro? If you invested, right, in a euro denomination, and then the euro goes down against your dollar, right, it's eroding your returns in the euro denomination, I think. So again, these were all things that we talked about, not really day trading or technically related, but I guess interesting nonetheless, right? So all things you should need to consider, all right? And with that, I call the day here, and I'm gonna wish you a very good rest of your weekend and a good start of next week. Remember, next week, beside the usual oil spike or oil volatility, let's call it, that we will see for sure. It is also FOMC week, so, double volatility if you wish. I'm not expecting a lot out of FOMC, to be quite honest, but, there is always a driver for potential volatility, especially intraday or intra-week, so just be aware of that, right? Up until that point, as usual, be nice and be cool, Neil's out.
Shit, this is really gonna affect people.
Yeah, it's gonna affect people like me.
Well, real people.
Jesus, Seth. Listen, if you really want to do this with your life, you have to believe you're necessary, and you are. People want to live like this in their cars and their big fucking houses they can't even pay for, then you're necessary. The only reason that they all get to continue living like kings is because we got our fingers on the scales in their favor. I take my hand off when then the whole world gets really fucking fair, really fucking quickly, and nobody actually wants that. They say they do, but they don't. They want what we have to give them, but they also want to, you know, play innocent and pretend they have no idea where it came from. Well, that's more hypocrisy than I'm willing to swallow, so fuck. Fuck normal people. You know, the funny thing is, tomorrow if all of this goes tits up, they're gonna crucify us for being too reckless. But if we're wrong, and everything gets back on track, well then the same people are gonna laugh till they piss their pants because we're gonna look like the biggest pussies God ever let through the door.